Government money power. We're talking about this in relation to different exchanges between different countries. So you look at a couple of things, currency exchange controls. They can sit down and as a government, they can control the currency exchange between their currency and other currencies within their own specific borders. The motivation really is to manage foreign reserves and the impact they may have on their own reserves as they go through. So they have different tools, currency controls, exchange rates. They have one of the 8 different tools for exchange rates they can actually use if they choose to do so, if they engage into a specific contractual agreement or a new standard they set as a country, or they can just have open market floating rates like the US has. Sometimes you can have controls to make certain that convertible currencies can be exchanged for other currencies without any restriction or free floating aspect. And then sometimes you may want to sit down and just have a non-convertible currency value and arbitrarily fix it typically at a rate higher than its value in the free market, and the government can impose exchange controls. Sometimes this can happen in a matter of just from one executive order and boom, it happens just like that as you go through. Taxation also is another force you can exert on the organizations that are already companies in your country, but also those trying to do financial economic transactions within your country as you go through. Typically, there's 3 general types of taxes. One is an income tax. In other words, any kind of income the company gets, you sit down and be taxed upon as you go through. Another is a very dangerous taxation, at least in my opinion. I've written a couple of papers on the topic called the value added tax. By that, for instance, a table is sold at a retailer, and so somebody walks in and they buy the table and they pay a tax, a sales tax on it as they go through, and that retailer has to collect that tax and turn it into the government. Except with the value added tax, somebody goes through, they buy a tree in a farmer's field as they go through, and the farmer has to pay sales tax on that, a value added tax. The person then takes the tree that they just bought from the farmer, cut down, they take it to the mill, and they sell it to the mill. The mill pays for the log that's delivered, and the mill has to pay sales tax to that person. The mill cuts into boards. They sell it to a furniture maker. They have to pay tax on that, and so on and so on and so on. So just for that log to sit down and be cut in the farmer's field, the farmer's got to pay. The logger has to pay. The mill has to pay. The furniture maker has to pay. The final finisher has to pay. And then finally, the person actually puts it all together with the final finishing coat on it. They sell it to the retailer. They have to pay. And then the consumer pays 7 levels of taxes, and even more sometimes, depending on how many hands are changed in the process of going from raw material to the finished product as you go through. Value-added taxes are common in Europe or socialist organizations as they go through. As far as I know, it's only been implemented once in the United States with disastrous results in the state of Michigan. They retracted it after the foolishness of implementing it here in our country as you go through. You also have the withholding tax, where you sit down and withhold certain aspects, and it depends as to what you have. Typically, a withholding tax is a payroll tax, but it depends as to how the nation withhold it from either corporate earnings or from wages of the employees there as you go through. You can see once you start weighing all the taxes and adding them all up, they can become a huge percentage of overall profitability, sometimes to the point of actually making it unprofitable as you go through. So sometimes when you go into a country that has high corporate taxes, you need to sit down and plan carefully as to how you present your numbers to the government. And if you can, make certain that your tax bill is the lowest profile possible by making certain that you do different activities in different countries as you go through. Here's other financial forces as they go through. Inflation is 100% under control of the government. If they print too much money, then sometimes you have too many dollars chasing too few goods, they call it. Pretty much that's called inflation as they go through. If the government decides to print money and give it away nonstop to their friends and family as they go through, then all of a sudden you have an economy that's unfettered and uncontrolled, depends at the level they have. And then it really determines the real cost of borrowing in capital markets for that country as you go through. Rising rates under control of the government, they encourage borrowing as they go through. So you really want to sit down and look as to what's going on. Inflated currencies tend to weaken the borrowing. And then interest rates rise with inflation typically as well. So you can sit down as the government prints more money to sit down there and achieve what they want for their own economic goals within the country. They can drive inflation up and really damage the infrastructure of the country. And then sometimes to the point of hitting 5, 8, 10. Some countries, they have hyperinflation, so it's 100% annually as they go through. You also have to cope with this concept of balance of payments. Make certain you understand this concept over here. It's a record of the country's transactions with the rest of the world as you go through. And it shows flow of capital in and out of the country. So you're buying goods from another country, they have payments going out to the country you're buying the goods from as you go through. When you have exports and you're shipping them out of the country, they're paying money into your country, then you have more currency from that country coming in. So it's a constant balancing act of balance of payments as you go through. And the demand really shows what happens with the country's currency. Typically, balance of payments is just as basic as normal bookkeeping, and you may all take it at some point on accounting called double entry bookkeeping. Payments to other countries are debits, payments from other countries are credits as you go through. Pretty simple, basic double entry in the process as you go through. Current accounts, they really track aspects of things that are happening, such as services and aid as you go through. Capital accounts tracks the financial assets and liabilities as you go through, investment portfolios, capital flows as you go through, and the term official reserves reflects your gold imports and exports as you go through. So 3 different categories when it talks about surpluses as you go through and deficits. Here is actually a chart that I borrowed from the Khan Academy, which is actually online. They have a lot of really good materials as you go through. You can kind of see when you start looking towards future balance of payment issues or current as you go through, you always track with the credits and the debits as you go through. So in the future, okay, is the money, is it coming into the country or is it going out? If it's coming in, boom, it's a credit. If it's going out, it's a debit as you go through. And the same thing was happening currently is happening. The transaction is actually immediately going on. Then you track it in a little bit different categories you go through. It's called balance of payments. The US typically receives a lot more imports coming into the country than we have exports on the way out. So we tend to be what's called a debtor nation on the balance of payments as you go through. And we have a lot of trade deficits on the balance of payment as you go in the process. So to understand a deficit, you have to look at the total picture by the time you're all done. So the current account deficit may mean economic problems such as inflation, or that demand in the country exceeds the outward flows, which is pretty typical for us as a country. Government money power plays a crucial role on a lot of different aspects as to how that country responds to the international community for monetary funds in the process. So it depends also as to what position you want to take and how you deal with issues as they come through. So keep in mind, currency exchanges, they're controlled within countries' own borders. The balance of payments is how the country goes through and they try to track their imports, exports, and their debts to other nations in their process of purchasing goods and selling goods. And there's at least 3 different kinds of general taxation as they go through. And then inflation between countries can strengthen or weaken a country's currency. And sometimes inflation is deliberately done just for that in the process, because each individual government is underneath the control of their own leadership that the people either elect or they decide to go take over any day, whatever. The world is a different place. Hopefully, the people always have a say. With that being said, government money power really rules the interior of the country, but also has an impact upon the world around it as many transactions as it can possibly have. Take care.